There was a time when Dubai's real estate did not simply grow, it accelerated. Glass towers rose from the desert like declarations rather than buildings. Waterfront districts expanded steadily into the sea, reshaping geography itself. Luxury homes often sold before foundations were complete. For many global investors, this was not a traditional market cycle, it felt like direction. Always upward, always faster, always expanding. Yet something in that rhythm has begun to change. Not a collapse that announces itself loudly, but a quieter recalibration in momentum. Listings remain longer on the market. Transactions require more time. Capital that once moved instinctively now behaves with hesitation and calculation. The question is no longer whether the market is active. It is whether it is still accelerating. This may not represent a sudden breakdown. Instead, it reflects a gradual shift in financial confidence. At its peak, Dubai's real estate sector offered a very specific promise, not just ownership of property, but access to a system engineered for global mobility. Zero income tax environments. Strategic positioning between continents. Infrastructure designed for speed, efficiency, and international capital flow. For many investors, this was not simply diversification. It was positioning. Capital was being placed inside a city that appeared to compound its global relevance year after year. For a long period, the indicators supported that belief. Prime districts recorded high occupancy. Pre-construction projects attracted strong demand. Luxury segments posted record transactions. New supply was absorbed at remarkable speed. The narrative remained consistent. Demand exceeds expectation. However, systems built on momentum carry an invisible requirement: continuous inflow. Once that inflow becomes less automatic, even marginally, perception begins to adjust before the data fully reflects it. At surface level, nothing appears broken. The challenge lies elsewhere, not in performance, but in rhythm. Real estate markets function as both financial and psychological systems. They depend on belief as much as balance sheets, and belief rarely changes all at once. It shifts gradually, often before measurable indicators respond. For certain investors, early signals began to emerge in subtle behavior. Holding periods extended. Price negotiations became more aggressive. Exit liquidity received more attention than entry opportunity. Questions that were once secondary moved to the center of decision-making. What happens if growth slows? What if demand becomes selective? What if exit timing matters more than entry timing? As these questions accumulate, the narrative begins to evolve, not toward expansion, but toward reassessment. Once that phase begins, even strong markets enter a different psychological condition, one defined less by acceleration and more by scrutiny. In its golden era, Dubai's real estate market did not behave like a conventional housing cycle. It functioned more like a global magnet for capital. Investment flowed in from Europe, Asia, Russia, and beyond, with a consistency that appeared almost self-sustaining. Each new tower reinforced the last. Each record-breaking sale strengthened the narrative. Each incoming wave of buyers helped create conditions for the next. At first glance, the pattern resembled unstoppable demand. Yet beneath that surface, a more precise mechanism was operating. A confidence loop formed. Prices rose because prices had already been rising. Developments expanded at scale, master-planned communities, artificial waterfronts, and branded residences tied to global luxury names. Prime districts maintained strong occupancy across cycles, while off-plan sales surged during expansion phases. Infrastructure development moved in parallel with ambition. Airports, highways, business districts, and logistics hubs, all reinforcing the same trajectory. Everything pointed in one direction: growth. For many investors, however, the attraction was not only appreciation, it was velocity. Capital could enter quickly, grow rapidly, and often exit with comparable speed. In global markets where liquidity is as critical as returns, that combination was rare. For a period, the system appeared to function with precision. Luxury real estate transactions reached record levels. Prime assets traded at valuations that reflected not just physical scarcity, but narrative strength. Ownership in Dubai became participation in an evolving global story. A story built on modernity, scale, and international integration. But what makes this phase significant is how quickly systems evolve when expansion accelerates beyond equilibrium. Rapid growth introduces a structural dependency. Sustained demand must continuously validate prior pricing levels. During expansion, that dependency is often invisible. It becomes apparent only when momentum slows. The earliest indicators rarely appear as disruption. They emerge as friction. Transaction timelines extend. Due diligence becomes more detailed. Developers introduce incentives more frequently. Secondary markets begin to show sensitivity between expected and realized value. Not collapse. Adjustment. And in real estate systems, adjustment is the stage where perception begins to outweigh momentum. Because the central question is no longer how much demand exists. It becomes how confident that demand truly is. Confidence, unlike physical infrastructure, cannot be constructed. It exists in sentiment, in comparison, and in the growing visibility of global alternatives that appear increasingly stable or predictable. As those alternatives strengthen, even dominant markets begin to experience a different kind of pressure. Not disappearance, not decline, evaluation. And once evaluation begins, everything that follows starts to change in tone, even if the underlying structure remains intact. The first signs of friction did not arrive as headlines. They arrived as behavior. At surface level, the market still projected strength. Towers continued rising across the skyline. Marketing campaigns maintained their language of confidence. High-end districts still reflected the visual identity of expansion and luxury momentum. Yet beneath that visibility, something quieter was shifting. The pace of conviction. In real estate cycles, the earliest signal of stress is rarely price. It is hesitation. Investors who once moved quickly began extending decision timelines, not exiting the market, but recalibrating how they engaged with it. Comparisons became more detailed. Questions became more pointed. Not how much will this grow, but how easily can this be exited? That change is structural. It signals a transition from growth-driven behavior to risk-aware positioning. The issue is no longer only valuation. It is liquidity under changing conditions. What becomes increasingly visible is how sensitive high-end property markets are to perception shifts. When demand is driven by global capital rather than local absorption, pricing becomes tightly connected to external forces, interest rates, currency movement, geopolitical stability, and competing global opportunities. Gradually, the comparative landscape began to shift. Other global cities started offering different forms of appeal. Some emphasized legal predictability and institutional depth. Others relied on historical continuity and cultural permanence. A few demonstrated slower appreciation cycles that reduced exposure to volatility. Dubai still represented speed and scale, but speed in isolation does not guarantee preference, because the challenge is no longer only attraction, it is retention of capital once it arrives. This is where narrative dynamics become critical. Once investors recognize multiple viable destinations, capital behavior changes structure. It no longer flows in broad momentum, it becomes selective, filtered through analysis rather than assumption. Selective, measured, comparative. In that environment, even strong markets experience uneven absorption. Prime locations often remain stable due to established demand. Mid-tier and speculative segments begin to stretch in timing. Off-plan developments increasingly rely on incentives to maintain momentum. Secondary markets start pricing uncertainty earlier in the cycle, not collapse. Segmentation. And segmentation often marks the point where a market transitions from expansion toward maturity. or in some cases, from maturity toward correction. Beneath this visible layer, a deeper structural pressure begins to form. Rapid expansion compresses future expectations. When supply enters the system aggressively, future demand must continuously validate prior assumptions. If that demand slows, even slightly, imbalance becomes more apparent over time. It does not fail abruptly, it accumulates quietly, until perception adjusts not because of a single event, but through repetition and comparison across alternatives. Once comparison becomes the dominant framework, confidence stops being absolute. It becomes conditional. That is where pressure begins to intensify. Because markets rarely require panic to shift direction, they require only reassessment. And once reassessment becomes widespread, it rarely moves backward quickly. The turning point in most cycles like this rarely resembles a collapse. It resembles a re-rating of confidence. In Dubai's real estate narrative, that adjustment appears to have emerged through a combination of external pressure and internal saturation. At surface level, nothing appears dramatically altered. The skyline remains intact. Construction activity continues in selected zones. Luxury districts still project ambition and scale, yet the issue has never been simple visibility. It is intensity. And that intensity has been gradually recalibrating. Global monetary conditions tightened. Liquidity became more expensive. International risk appetite shifted toward caution. In such environments, assets heavily dependent on capital inflows tend to respond first, not through breakdown, but through reduced momentum. And in high-growth real estate systems, momentum is not a secondary variable. It is the core mechanism. What makes this shift more significant is how quickly sentiment adjusts once easy growth is no longer assumed. For years, many investors operated under the expectation of continuous appreciation and reliable exit liquidity. As conditions changed, focus quietly moved from expansion toward capital preservation. This is where smart money behavior becomes visible. Long-term holders begin reassessing exposure levels. Short-term participants become more selective with entry timing. Secondary market transactions start influencing price discovery more than off-plan projections. Not withdrawal, repositioning. And that distinction is essential. Because the issue is not panic, it is recalibration. However, beneath the surface, a structural tension builds, the timing gap between supply delivery and demand absorption. Large-scale developments initiated during expansion phases begin reaching completion in a different macro environment. Inventory that was priced under growth assumptions now enters a market shaped by more selective demand behavior. That creates friction. Absorption slows. Incentives increase. Payment structures become more flexible. Marketing shifts away from pure expansion narratives toward value positioning and affordability framing. These are not signals of collapse, they are signals of adjustment. But perception does not always separate the two clearly. And this is where sensitivity increases. Because when global investors observe slower absorption rates, they do not interpret it as neutral timing, they begin reassessing the assumptions embedded in earlier valuations. Once those assumptions are questioned, pricing frameworks begin to soften. Not because physical assets change, but because the narrative supporting their valuation becomes less absolute. And in globally capital-driven markets, narrative strength is not secondary, it is structural. As a result, even without visible failure points, the system begins to feel different. Less automatic, more conditional. And once conditions enter the decision framework, every future move becomes more deliberate. Because what changes is not necessarily the market itself, but the certainty surrounding it. As confidence recalibrates, the effects rarely appear as a single event. They emerge as patterns. A slower transaction rhythm, a more cautious tone in investment discussions, a rising emphasis on comparison rather than conviction. At surface level, the market continues to function. Buildings remain occupied. Transactions still occur. tourism-linked demand continues to support parts of the ecosystem. But the defining variable is no longer activity. It is intensity. And intensity is what defines premium real estate cycles. Because when momentum weakens, perception begins to fragment. Established prime districts continue to perform strongly, supported by proven demand history. Yet newer or more speculative segments now show longer holding periods and sharper price sensitivity. The gap between expectation and realized value is widening, slowly but consistently. Persistence is what matters most here. Markets rarely correct in straight lines. Instead, they adjust unevenly, across time, across segments, across sentiment. What stands out is how quickly capital becomes comparative under uncertainty. Investors no longer ask only, "Is this growing?" The question shifts towards something more strategic. Is this still the best place to hold exposure? That single shift changes behavior at its core. Because once capital becomes comparative, it becomes mobile. In global markets where alternatives continue strengthening, mobility becomes the dominant force shaping allocation. Other destinations begin re-entering the conversation, not as replacements but as balancing options. Some offer deeper legal predictability. Others provide slower but steadier appreciation cycles. A few present luxury ecosystems less dependent on expansion narratives and more anchored in long-term structural demand. Dubai does not lose appeal in this process. It simply stops existing in isolation. Competition, in capital markets, is never static. It evolves alongside perception, liquidity, and global sentiment. Beneath the surface, another layer becomes visible: the re-evaluation of risk. Not just financial risk, but timing risk, exit risk, liquidity risk. The risk of holding through a cycle that no longer behaves as expected. When those considerations enter decision-making, behavior shifts without needing external shocks. That is where the real transformation begins, not in prices, but in positioning. Smart capital rarely exits loudly. It rotates, it reallocates, it waits for clearer alignment between price, timing, and confidence. That waiting produces visible effects: slower absorption in select segments, greater reliance on incentives, and a clearer separation between headline luxury and transactional luxury. None of this implies disappearance, but it does suggest a change in market character, from expansion-driven behavior to evaluation-driven behavior. Once that transition begins, it reinforces itself. Perception shapes demand. Demand reinforces perception, or weakens it, depending on direction. So the question is no longer whether the market is active, it is whether it still carries the same level of unquestioned certainty it once did. And in real estate, certainty often holds more power than growth itself. And in that transition, what becomes most important is not whether activity exists, but what kind of activity it is. Systems built on rapid expansion do not stop functioning when momentum slows. They continue operating, they adapt, they rebalance, yet the meaning behind their movement begins to shift. At surface level, nothing appears fundamentally broken. Infrastructure remains world-class. The skyline continues to dominate global imagery. Transactions still occur across multiple segments. But beneath that surface, the assumptions that once supported aggressive valuation begin to soften. That is where transformation actually takes place. Luxury real estate in globally connected hubs is not driven solely by local demand. It is shaped by international perception, cross-border liquidity, and comparative confidence. When confidence is absolute, markets appear unstoppable. When it becomes conditional, movement does not end, it decelerates structurally. What makes this shift more significant is its invisibility at the beginning. Longer decision cycles emerge. Negotiations become more detailed. Exit strategies receive greater attention. Macro conditions begin to matter as much as local narratives. As these behaviors spread, the system starts operating under a different logic. not collapse in the traditional sense. Recalibration. Yet recalibration can still feel like contraction to systems built on acceleration. Because luxury was once associated with permanence, over time, it has become more closely tied to sentiment cycles, capital mobility, and global comparison frameworks. In such an environment, no destination remains fully insulated. Looking ahead, several trajectories remain possible. Stabilization represents one path, where excess supply is gradually absorbed, pricing expectations adjust, and the market evolves into a more mature but lower volatility ecosystem. Dubai, in this scenario, remains a global hub, though with slower expansion and more selective demand. Stagnation presents another outcome. Certain segments continue to lag while prime assets hold firm, creating a divided structure within the market. Activity persists, but unevenly, strong in some areas, subdued in others. Reinvention forms a third possibility. Here, the focus shifts away from speculative cycles toward long-term residency demand, infrastructure depth, and broader economic diversification beyond real estate-driven growth. Each scenario depends on a single underlying force: confidence. In global property systems, confidence is not abstract sentiment. It functions as an operating layer that influences pricing, liquidity, and participation itself. Once confidence stops being automatic, every transaction becomes more deliberate. Every investment is weighed more carefully. Every decision is measured against timing risk. So the question is no longer whether Dubai's real estate is in decline in a literal sense. The question is whether it is evolving from a momentum-driven cycle into a confidence-tested system. And that distinction shapes everything that follows. Because what ultimately changes may not be the physical city itself, but the certainty investors attach to its trajectory. And in markets governed by perception, certainty is often the most powerful form of capital.